Okay, everyone, hopefully you can see my desktop. I just want to go through, before we start, just a couple of our disclosures that this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation and endorsement of any particular security, chart pattern, or investment strategy by forex.com. This presentation has been prepared without regard to the specific investment objective, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Also, do remember this, guys. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act due to regulatory reasons. All right, guys, let's get going. To start with, obviously, I'm going to pull that up, but I'm also going to bring up a new chart because I want to something fresh off the press. Some of you may have been wondering what's happened with these emerging markets. There was a trend going on at one stage and there doesn't seem to be any more. And in fact, we've been blindsided a little bit by it, particularly on the South African round side of things. What you can see now, this is just an economic calendar with some South African data, which may explain to some of you who were trading the rand, maybe short, why we've seen this kind of recovery in the rand. As you can see here, the unemployment rate was better than expected for 4Q, and we also got a better than expected manufacturing production report as well. So hence why, let's just pull up the round here. As you can see here, dollar's just really pulled away. Now we're still looking quite strong. However, I certainly believe that there's still some room for some upside. But at the moment, we're in a bit of a risk-on environment, and that is good news for the rand for sure. But couple that with what's been going on with the emerging markets as well, and you're getting with the kind of what's going on in stock markets, and also the better domestic data coming out of South Africa, and you have got a much better, you've got a better environment, I think, for the rand. So if for those of you interested in maybe going short the rand, now may not be the best time. I'll be watching to see if we get to this level, which is around about 10.94.70. If we get below there, then that could suggest a much deeper pullback. But right now, we're currently trading at around 11.02.85. We're towards the lows of the day so far. And if we continue to decline, then we could certainly see maybe just a sharper pullback. Obviously today though, we don't really have too much economic data out of the majors. All focus is going to be on Janet Yellen. She's the head of the Fed. I'm sure all of you know that. But she will give her first testimony to the US Congress later today. Let's just take a quick look at what that means for the dollar as we progress towards this really important press conference today. As you can see, the dollar has actually been pretty weak. Obviously, Friday's payrolls report didn't help, but we saw it weaken actually throughout last week. So we're just seeing continuation of that as we move through this week. Alan, I've got my feelings to go long Aussie dollar. Will I be shorting Aussie here and Kiwi from last evening? Bear with me, Alan. I will talk about it in a moment. We have some direct experience of the Aussie. So as you can see with dollar index, it is looking very, very weak. But it is hot. We're approaching a key level, which is this 100-day moving average, which is the green line on this chart here. That comes in at 80.47. We're currently trading around 80.53. So we have managed to hold support there. And whether or not we get below it depends on Janet Yellen. Now, as you can see, this sell-off here over the last few sessions, or really since the beginning of February, is partly a reflection of the market expecting Yellen to be very dovish. And in fairness, we've seen kind of the dollar sell off really overnight across a lot of currencies, including the Aussie, Alan. And that has certainly weighed on, that's the dominant theme, I believe, as we go into this meeting. However, there's a good chance that she'll actually be neutral. We don't think she's going to say anything yet. We don't think they're going to abandon their pace of tapering as yet. And if they don't do that, then the biggest risk for us is going to be a less dovish than expected surprise. So in the same way that we saw the euro recover last week on the back of the Draghi being less dovish than expected, the market is almost hardwired these days to believe that central bankers will be very, very dovish. When they are less dovish than expected, that is when we see the big moves in markets, and that's when we see that when we see that things maybe aren't, the market had expected Yellen to be this uber dove, much more dovish than Ben Bernanke. Well, what if she's actually more pragmatic? And we believe that she is going to be pragmatic, that she's not going to want to rock the boat. Alan, I completely believe with you, and that she'll continue to taper 10 billion per meeting. I do not think this is the forum for her to change her mind about something so big and so important to the markets as this. So hence what we've got, this 80.47 level is holding us good support there. And if anything, we could see a nice reverse course. Now, Alan, you also talked about dollar yen will eventually going to test 100. I mean, partly it will depend, certainly maybe not in the next few days. But I'm going to look at Aussie now, because obviously He's been one of the better performers coming out of the entire G10 currency space. As you can see here, nice break above that 50-day moving average, which came in at 89.09, and then now we popped above 90 earlier. That was on the back of some better consumer sentiment data coming out of Australia overnight. So two major risk events, right, Alan? Or those of you who think about going long Aussie here, the first one is Yellen. If she's not as dovish as expected, we would think that the Aussie would get hurt a little bit because of, we think that would hurt risky assets, and the Aussie, as you know, that the real risky end of the G10 FX spectrum. We also think we have the employment data coming out on Thursday, overnight on Thursday, so very early Thursday morning. Sorry, overnight on Wednesday, very early if you're in the US. Very early Thursday morning if you're based in the UK, and that they're the two kind of key risk events that could really knock this off course. You may remember that the employment data, or that some of the data in Australia was actually picked up. The employment data hadn't actually; it had been quite weak. So we are looking for a nice recovery there. But if we don't get the recovery that some expect, then that could be when we see, that could really thwart the upside in the Aussie. So for those of you that maybe have run the Aussie, maybe from around about or just below that 50-day moving average, then it's the time maybe to think about reducing your positions, because obviously we are approaching two major fundamental event risks that it's very difficult to predict ahead of time. In terms of resistance, though, if we were to get there, these highs from January, let me just get a 1 month chart, just bear with me, guys. I think I'm going to have to go back a little bit, actually. Let's just go back to January. These highs here from the 13th, 14th of January, which come in at 90.86. That's the kind of level to watch now. We're about 50 pips away from there. We've, just been extending gains, really. We certainly haven't been pulling away in any way, shape or form. Obviously, 90 is a psychological level. 90 was a psychological level. And then, of course, you would get down here, it wasn't that long ago. It was only on Monday that we were, testing that 50-day moving average, which comes at 89.09. Alan, 2013 was 90.90 area. I'm not sure what you're referring to. 2014 high, I believe, is what you're referring to, being the 90.90 area, and that's what I just pointed out. That's from the 13th of January. Obviously, the high from 2013, however, was 105.45, which came in all the way back in April. So we're some way from there. So, obviously, as you can see, the Aussie, looking at it just a very plain line chart going from over the last 12 months, we were looking chronically oversold really at that stage. So, a pullback here is to be expected. Added to that, we have seen the RBA change tack. They have changed to a neutral stance. However, they are still worried about the currency. So for us, we believe there could be further upside in the Aussie, that maybe we'll get back to these kind of December highs here around about that 91.70 level. But we think it's going to be hard to fully extend gains and, really see a lot of upside, but even back to those kind of 95 highs from November. And that is because we do think that the RBA is still very worried about the currency. And we know that some of the governors, some of the members of the RBA have come out and said that they, that they think it should get down to 85. One even came out last week and said it should be 80. So we think that any kind of move, sustained move back above those December highs could actually trigger just a little bit of intervention risk. And by that I say rhetorical intervention risk from the RBA. And we know in the past the RBA have been pretty good at that rhetorical intervention risk. So also, Alan, you were looking at Kiwi as well. While we're in the region, why not? Kiwi, as you can see here, is just still trading within that range. Yes, it's moved higher today. It's been very much pulled up by the bootstraps, if you like, by what's going on with the Aussie. But we're still way away from that 84 level. So the Aussie is still really leading the way. We've got some nice levels of support here. If Yellen does throw, maybe if Yellen is less dovish than expected, we've got the 100-day, which comes in at 82.73, and then 82.50, or just below 82.50 is the 50-day moving average. That is that there are two levels that may just cushion the downside of Yellen is slightly more dovish than expected. So someone's asked me about sterling yen. And I know that, Alan, you also wanted me to look at yen. So now seems a good time to do that. As you can see with dollar yen, we had kind of broken higher, but look at that. I mean, it doesn't take a genius to figure that out. We are kind of trapped between two moving averages. So we are very much range bound. We are static. There's a couple of things I want to point out from a very, very short term basis, as you can see here. We did make a series of higher lows, which suggests a bit of a recovery is in play. However, we are really flatlining. So to me, we're still just we're in just a holding consolidation pattern, and that's very normal. We're in it's very we've been waiting on some key Japanese data to come out this week, but obviously the most important thing for us is going to be Janet Yellen's testimony. We do get some CPI data, and then the 4Q GDP coming out of Japan. When is the 4Q GDP? Let me just double check. That should be on Monday, on the 16th, or overnight on Sunday, sorry, on the 16th. So, we're going to be watching that very, very closely. We're also going to be watching, it's Janet Yellen, that's the real key thing. Dollar yen, as I'm sure loads of you who follow, dollar yen closely will know, it's probably the most sensitive to what's been going on to monetary policy, particularly changes in monetary policy. Now, if we think that Yellen is going to take a neutral stance, maybe that's not going to be dovish enough, so we could actually see the dollar rise a little bit, particularly against the yen. It has shown a tendency, even though it's been falling against other currencies, it has actually risen against the yen. So it suggests that there may be just some resting unease maybe with that dovish bias that the market seems to have as we lead up to this Yellen testimony. Just to run through that with you very, very quickly. Remember, the testimony is released at 8:30, but she will not testify until 10 o'clock US time. So 1:30 London time is when we get the testimony released. It will be over the wires, all over the newspapers, and then at 3 o'clock is when she speaks. So as you can see here, though, she's overly neutral, but we do get a knee-jerk reaction higher in the dollar. We would expect this 50-day moving average to act as a good resistance zone. That comes in at 103.5, and that would be kind of the level that we would be looking at there. Looking at cable yen as well. I will just bring that up now. Bear with me one moment. As you can see, it looks very, very similar. Sterling is doing very, very well today, with cable up above 164, testing around about that 164.40 level. As you can see, it looks very, very similar, right? So it's come off since the start of this year. Let me just put a fib on that as well, so we can just take a quick look at where we are. It does look to me like we've made a bottom at this level here, which comes in around about 163.70, and then the next level on the upside is 169.30. So we're currently trading 168.20, 169.30, and then 169.98. That is 169.30 is 169.27 is the 50% retracement of the sell-off since the start of this year. And then the 169.98 is the 50-day moving average. So that area there could be quite sticky if we are to get some further upside. Obviously, tomorrow is a big day for sterling as well. We get the inflation report, and if Carney can't really, Carney and Co at the Bank of England can't reinforce to the market that they're not going to be hiking rates anytime soon. If the market doubts them, that could be sterling positive. So we could see a bit of upside there in cable. And on that note, I will actually look at cable here, because cable is quite interesting. The market went net long again, or increased their long sterling positions last week. A lot of people had thought that, once we got to this 166 level and then we fell all the way back down to kind of 162.5 last week, that we were a bit of a goner. But that we did manage to hold some key support. We held above 162.20 or 162.29, sorry, which is the bottom of the daily Ichimoku cloud. And now we've, done that typical, retracement pattern really, whereby we're now pushing higher. Looking at it from, let me just pull this chart back up. As you can see here, those highs come in at 166.68. However, that was a false break higher, we think, because 166.35 is a key level of resistance. That is the 200-month moving average. That is a really important level. Now, we are, as you can see, just testing around about that 50-day, which comes in at 164.20. And we've held on nicely to that. But as I said, the 164.40, let's go back to that Ichimoku cloud. Here is just thwarting the upside a little bit. If we do get above there, then we'd probably be looking at the late Jan highs around about 165. That's also a nice whole number. But obviously where we go from here is going to be dependent on a lot of risk events. And I could imagine us actually trading sideways a little bit. I also think that if we get a big rebound higher in the dollar, the cable could actually be, or sterling could be just a little bit more immune to it, just because there is that uncertainty tomorrow with the inflation report coming out from the Bank of England. So do mind yourself for that. That comes out at 10:30. It's certainly worth watching very, very closely in our view. We know in the past that when these inflation reports and forward guidance has been announced, for example, back in August, the market really just ignored what the central bank did and continued to move higher. You can see it here. It's probably around about this. This very long bar here was when forward guidance was announced, and the market went the opposite way and actually pushed higher. And we saw a really nice trend. Now, we don't think we're going to go back into this situation, but we think that right now we're just consolidating. We still think that 166.30 is going to be, or 166, above 166 life is going to be very, very hard, and people are going to be taking profit left, right and centre. But I think right now, you've got to remember, until we hear more from, there's a lot of central bank risk out there, but one thing we do know is that the UK's employment outlook is actually better than the US's after those very weak payrolls reports in November and December. Now it all comes down to, we've got the payrolls out of the way. Now it all comes down to the central bankers. Will it be, will Yellen err on the side of dovishness like the market expects, thus limiting dollar upside? Or will Carney, be able to persuade the market that he means business and that rates aren't going to rise at all this year? And anyone who's kind of priced in the prospect of a rate hike at the end of this year, which is about 30% of the market, in fairness, quite a lot of people, they're all wrong. And if you can get them all to change their mind, then that may also limit pound upside. But there's a lot to ask for, and right now it is erring on the side of pound strength versus the US dollar. So that's what we're seeing here. But as I said, technical levels are coming into play, and they are going to stay in play. If we get above this 64.40 level, or top of this daily cloud, we want a daily close above there. We then, that really then opens the way to that 166.35 level. So that's kind of the key level to watch there. Now, what we haven't looked at so far has been euro. Oh, bear with me, guys. I'm just going to pull that up now. Not sure about anybody else, but it's been kind of one of those strange Januaries, really, or the strange Februaries, really, whereby there hasn't been, we've kind of just reversed course, and you can really see that in euro. Pan, he's already said there will be no rate hike. I guess that means you're talking about Mark Carney at the Bank of England. Indeed, he has. And in fact, at the Davos Forum, he actually said that, the bank will change its forward guidance to make it more tricky for the market to expect a rate hike. So, we do expect some of these things. In fact, I wrote a preview about it. I'm going to just send you the link to it now. Just bear with me, guys, one moment. Because it's really, this is one of his last chances, probably his last chance to make forward guidance work. So there you go, Pan, and for everybody else, do read that. That's our inflation report preview. Could be really useful, and it's got a nice look at sterling as well, about where that may go next too. So watch out for that. But as you can see here, let's talk about euro. Actually, euro's been euro's an interesting one always. As you can see, nice recovery, still managing to recover as well. It is maintaining its momentum higher. As you can see, nice reversal throughout February. Managed to bounce off those lows, which when we got to kind of 134.77, move through these, slice through really these two moving average former resistance levels. There are also some other there was some bullish development by having a daily close above 136.40, so that was quite significant. As you can see here now, we're testing the 50% retracement of that December high, or 27th of December high, which came in at 138.93, and then the low that we got in when was it? The 1st of February, or the 3rd of February, something like that, very early Feb anyway. So this is really significant. Obviously, if we can get above 136.44, opens the way to this kind of 137.33, or the 61.8% retracement of that move. And then you're looking at kind of 138, which is where we got a lot of interest, or where we kind of really hit a lot of resistance back in December. Obviously, we just managed one quick spike up there by 100 pips and then came crashing down again. So we would expect 138 to act as massive level of resistance once again. But as you can see here, if we can get it, once you're above the 50% retracement of a small down move like this, or a short to medium term down move like this, that's when you could maybe say that sentiment is changing. However, a lot of it will depend on Yellen today, so don't underestimate that. I mean, obviously the Fed is, I know we can go on and on and on about the Fed, but the Fed is the most important central bank in the world, and what they say still matters, particularly now. In the whole market seems to be interested in Fed tapering, and everybody seems to be interested, be that Turkey or every corner of the globe is impacted by it. It's always worth, watching out for. On that note, I'm going to look at Turkey, because the Turkish lira, I did start obviously with the rand, and the Turkish lira is looking fairly similar as well. As you can see, it's now testing that 220 level. If we can get below there, that would be a very bullish development that would open the way to 216.14, which is the 50-day moving average. And that's, we're now kind of back at those lows, those pre-intervention lows. So, the market is liking what it sees. Obviously, Yellen has a chance, or it could attempt to disturb this, see an about turn. But for now, it does look like the turmoil, or certainly the extent of turmoil that we saw, was a little bit out of. There's just not been an extension of it. So instead, we're still in recovery mode. And it may take something, a particularly hawkish Yellen to change us out of that. Obviously, if she's not as dovish as expected, we could see some short-term gains. But it seems to me that the market is now comfortable with emerging markets and 10 billion per month of tapering. And I think that's a significant development for the market, because obviously this time, 3-4 weeks ago, that was not the case. The market was getting into a right panic. As you can see here, it was really from the 13th of Jan, all the way higher, all the way up there, caused quite a lot of, or an awful lot of pain to those who were long the Turkish lira. But since then, we've, had quite a nice recovery. So that's what that suggests to me. So even if you don't actually trade Turkish lira, it's a nice one to just garner sentiment overall for the market. So, Pam, you've looked at oil. Yes, oil's been really interesting. When there was a time when oil used to react to the non-farm payrolls reports, but not anymore. Instead, as much as the non-farm payroll report has been impacted by weather in the US, so too has oil. As you can see, oil was probably WTI in particular was one of the most hated asset, or one of the kind of most ignored asset classes for such a long time, really since the 4Q really. Of last year, as you can see, when it fell from that high above 110, but now we're back above 100. So what happened? So we got to a low in kind of mid-January, and since then we've been moving higher, but it's not been without its, it's not been a straight line, as you can see. We had a lot of kind of meandering around between kind of 95 and 98. But then we really, broke above some key levels, and then we broke above that psychologically important 100 level. A lot of people are putting it down to tighter supply than expected, and also the cold weather. So this could be a temporary move. Obviously we're now kind of around about these highs from December. Let me just just shorten this time frame of this chart, just to get you some, key levels. 175 was the high from the 27th of December. So that's very much on the cards now. It's only about 40 odd pips from where we are currently, trading at 100.33, 100 spot 33. If we can get above there, then it opens the way. 102 is your first level to watch out for. But then you're kind of looking at, almost back to 105. There isn't too much in the way there. Let's just go back to 1 year chart. So there was another, there are a few levels of resistance that could scupper, what some of the bulls are doing. Obviously, as I mentioned, we've got that 109 spot 90 and then 101.66, which is the 50% retracement of the high from when was it? Late August, when we came in at 112.24, to the low where we came in at just above 90 or 91.08, which was the low from January. So we've seen a real, about turn, and it's been a frustrating couple of, 6 weeks or so for the markets, because themes that had been looked like they may be playing out have just really reversed course. So this is the type of market to be on your toes, to watch out for. Obviously the weather is playing into oil, so keep an eye out. That can be kind of interesting if you're trading oil, and make sure that you widen your net of research. Don't just look at technicals or look at the economic fundamentals. You also do have to look at the weather reports, because if there's any type of tight supply, or even the weather causes the tight supply, that can be what causes a problem. But over the longer term, we still think that the outlook is quite bleak for oil, particularly for WTI, due to all the new production coming on board. So this to us is just a temporary effect. Okay, anybody else got any questions? Gold. Someone asked me to comment on gold. I'll have a quick look at gold, and then I will let you all go. Gold has had a nice push higher. We are, continuing to extend it to the upside. It's been nice, slow and steady. I think that's the thing to watch. Obviously, again, gold can be impacted by what's been going on with the central bank, the Federal Reserve. So you do have to watch that quite closely. Obviously, as you can see here, 1300 is a very significant level, and then 1306. Sentiment does seem to be to the upside. Really nice uptrend there. I'm just going to look out for a few other bits. Bear with me, guys, one moment. From the high that we saw in August all the way down to the low that we saw in late December, another level, if we get above the 1306 level, which is the 50-day moving average, the 200-day moving average, that also coincides with the 50% retracement of that August to late December sell-off. And then above there, you've got kind of 1336, which is 61.8% fib retracement of that level, and just below those highs that we saw in October. So there's a lot going on. There are some key levels coming up, but right now, unless we see an extremely dovish, an extremely hawkish Yellen, if we do see a less dovish than expected Yellen, then we could see gold falter a little bit. So even though it's looking quite strong at the moment, do watch out for some key support levels. 1267 is the 100-day moving average, and then we get 1237.96. That is a 50-day moving average, which cups the downside from late last month, earlier this month, and has kind of been the springboard, if you like, or the platform where we've been moving higher. Gold is a bit like an asset class on its own. It's been helped today by news that apparently China's central bank has been stockpiling gold, but then it could equally be damaged by a less dovish than expected, or even mildly hawkish Yellen, who supports tapering, because tapering should not be good news for gold, because it essentially reins in inflation. But they are kind of, arguments that haven't necessarily worked on gold for a while. So my view is, look at it from a technical perspective. If you can manage to stay above, stay kind of above this 1285 level, opens the way to 1300, 1306, as I said, massive level of resistance, 200-day moving average and 50% fib level. And then that opens the way to 1336. Take it slowly, take it one day at a time if you're looking at gold, I would say, because there definitely seems to be a trend there. You can see it by eye. But the fundamentals are more difficult to justify, I would argue. Okay, everybody, I'm going to leave it there. I hope that's been useful for you all. Please do join me next week at the same time, same place. And thank you, everybody. I hope you enjoyed that.